From the library of the New York Stock Exchange at the corner of Wall and Broad Streets in New York City, you're inside the Ice House, our podcast from Intercontinental Exchange on markets, leadership, and vision in global business. The dream drivers that have made the NYSE an indispensable institution of global growth for over 225 years. Each week, we feature stories of those who hatch plans, create jobs, and harness the engine of capitalism. Right here, right now at the NYSE and at ICE's exchanges and clearinghouses around the world. And now welcome inside the Ice House. Here's your host, Josh King of Intercontinental Exchange.
When can I retire? It's a question that investment managers have long tried to answer and then work to prove that their products are superior to make your visions of that decades-long lakeside bliss come true. The trillions of dollars in life savings squirreled away from people across the world represents a large chunk of global assets. That people put money to work while you don't need it and don't have it stuffed in your mattress supplies much of the capital that fuels markets across the globe. Investment managers try to compete on performance, price, and process, but in the second half of the 20th century, a revolution was underway. For a long time, academics in their ivory towers looked down at financial analysis as something beneath them and not worth their energy. But this attitude changed drastically with the advent of modern portfolio theory about how markets functioned. The world saw a renaissance of how intellectual discipline could be applied to understand, analyze, and perhaps even beat the market. Slowly, those investment managers began taking that research and applying it to their products, creating new strategies and incorporating technology into how they analyzed securities. One of those revolutionary discoveries was born out of a simple idea that a broad fund that could track the full universe of securities might help investors reach their investment goals. The idea, built on years of research and iconoclastic individuals, would eventually become the more than $30 trillion index industry that has become a ubiquitous part of Wall Street. The index fund recently celebrated its 50th anniversary, and its assets continue to climb, surpassing hedge funds and private capital funds. It's proven to be the perfect subject for our guest's book that dissects the game-changing breakthroughs in finance that led to its creation, the wider adoption of technology to support it, and the larger-than-life titans behind the product. Robin Wigglesworth, the global finance correspondent for the Financial Times, is a self-described semi-professional Norwegian, despite the Harry Potter-esque name, and the author of the recently released Trillions, How a Band of Wall Street Renegades Invented the Index Fund and Changed Finance Forever. Our conversation with Robin Wigglesworth on the history of the index fund, the iconoclasts behind its invention, and the investment landscape is coming up right after this.
There's the gold auction and also the LBMA gold price. It's the world's price for gold, particularly gold which is delivered in London. 4 banks would travel to a room next to the Bank of England twice a day in order to run an auction verbally. And it worked like that for about 100 years. When some of these firms moved out to Canary Wharf, they decided that actually it was too much to be sending people to the room, so they moved it to a phone call to buy and sell and establishing a price. IBA took over the auction in 2015, and we moved it to an electronic auction on the WebIce platform, so it's fully audited. It's a proper electronic liquidity window, a market. Buyers and sellers can come together. It's still run as an auction in rounds of 30 seconds, and the final price we use as the benchmark for the entire gold market. It's been extremely successful since we took over. Volumes have increased, and they've pretty much more than doubled, and we've actually nearly tripled the number of participants that we have as well. And we publish the data transparently on our website so anyone can come and see what actually happened in the auction. We introduced a centrally cleared model with ICE as the central counterparty because that makes it much easier for new firms to join. Up to 79% of the volume has gone cleared. This is kind of the pattern that ICE has seen through how different markets have developed, but normally that takes 10 years, whereas actually it's taken 10 weeks in the auction.
Our guest today, Robin Wigglesworth, is the global financial correspondent for the Financial Times and author of Trillions, How a Band of Wall Street Renegades Invented the Index Fund and Changed Finance Forever. His reporting focuses on the biggest trends reshaping markets, investing, and finance, and previously served as the FT's U.S. markets editor, spearheading its coverage of financial markets across the Americas, deputy head of Fast FT, capital markets correspondent, and its Gulf correspondent. Welcome, Robin, inside the Ice House.
Hi, Josh. Thanks so much for having me on.
You and several colleagues, Robin, at the FT recently wrote a column focused on the West's response to Russia's invasion, including it's really some of the harshest financial sanctions and boycotts, not only in finance, but in culture, sport, and travel. From where you sit, can you outline the severity of these sanctions and what removing the 11th biggest economy from global markets has meant thus far as you've watched it unfold?
Well, to take the cultural aspects first, I mean, they're the ones that quite often gather a lot of attention. I'm Norwegian. I love the Eurovision Song Contest, which is a big thing here in Europe, even though Americans never really appreciated it, to put it mildly. Getting thrown out of that was a big thing. Getting thrown out of FIFA, the World Football Federation, Soccer Federation, was a huge thing as well. I mean, North Korea is still in FIFA. But that is kind of rolled into this broader cultural revulsion against Russia and Russians that, frankly, sometimes I feel might be tricky or even distasteful. Sometimes it seems to be that people want ordinary Russians in the West to denounce their country, which for all sorts of personal reasons might be very difficult to do. It reflects the scale of the transgressions that we've seen. This was a very naked 19th century style invasion of a neighboring country. Most of the time, even Russia's come up with some sort of, not very plausible pretext, but at least some pretext. Here, there wasn't really one.
I wonder if after Putin's crackdowns, your colleagues at the FT are still in Moscow. And I'm curious, from a broader standpoint, you've mobilized to cover military conflict before, but how has the Financial Times newsroom transformed to cover breaking developments in Ukraine?
Well, I really can't talk about the on-the-ground issues because there are all sorts of security issues around that. I can say it is, as you would expect, a major event, not just for people that cover Europe or the US or the State Department, but frankly, the entire organization. The FT, we're a big global newspaper, but we don't have the staffing of some of the major newswires, but we tend to sort of, flood the field. When there's a really big story, we want to do really well. And this is a story that has both, geopolitical, economic, and financial implications, global implications. I mean, just see what's happening in the entire commodity market complex now. So I think it's one of those stories where the FT can really show off the breadth of the global network, because this is a global story, even though the epicenter is in Europe.
You joined the Financial Times, Robin, about 14 years ago, covering the Gulf as its Gulf correspondent. Curious, what drew you to the Financial Times and the move away from reporting on your more favored Nordic economic and politics?
I think, like most people, careers can be a little bit haphazard and not really planned out. And some people are very good at making plans. I wanted to be a journalist, a foreign correspondent, didn't know exactly why or how, but studied a bit of journalism and international relations. And whilst I was working for the Guardian newspaper as a sub-editor, it's just basically laying out stuff online, I saw a job ad for a financial journalist in Dubai. And I'd studied the Middle East. I knew the square root of zero about finance. But one of the great things about journalism is that you kind of have a license to talk to interesting, smart people, and sometimes some really boring, evil people as well, sadly. But most of the time, smart, interesting people who are willing to share their time to explain something to you. And the day after I landed in Dubai, I was talking to a local sheikh about Islamic reinsurance, which is as wildly exotic as you can imagine. But I fell in love with it. I loved figuring stuff out and learning things. It's like being a permanent student, basically. And especially finance, I think more than almost anything, it just changes all the time. The markets are just a brutal, volatility machine that just throws out fascinating little things and developments all the time. And we see these professional investors get humbled year after year, decade after decade, because the markets are so fickle. So I love that. Fundamentally, when I joined the FT, I was a broad Gulf correspondent. I even got to be a war correspondent briefly in Libya during the civil war there, in Bahrain, a little bit Egypt. But finance was kind of the first cut, and the first cut is the deepest, as Cat Stevens said. And I've kind of stayed there ever since.
I mean, talking about figuring stuff out and learning things, when you're in Bahrain and Libya, You're in the middle of the Arab Spring. I mean, although the protest movements were each unique in each country, there was this common thread to end corruption and promote democracy. What was it like to be in the heart of those movements? I mean, if you're an old film buff like me and you watch Mel Gibson, Year of Living Dangerously, that's what I imagine it might have been like.
Well, it varied a lot. Bahrain had a weird feeling of a sort of undeclared civil war. So you just felt like you went down the wrong street. You might end up with somebody who really, really didn't like foreign correspondents there, or another street where they absolutely loved you there. So this was mostly the Shia opposition. And, generally, most people like being loved more than they like being hated. But you have to, as a journalist, you don't pick sides. You're there to report what's happening and to analyze it. I mean, this is what the FT tries to bring to the game. It's not just saying coldly ABC happened, but trying to add the context around it in a nuanced way. Libya was fascinating. I mean, the sad thing is the reason why quite a lot of journalists dream of being war correspondents is it is glamorous. And in some respects, it's dangerous, but the stories are quite often it's simple. Like the drama, you can't have to flim flap it up. Like when you're covering like a civil war in Benghazi and the fights and the political machinations around that, you don't need to sell to readers why this matters really. I think in finance, quite a lot of people end up getting very nichey. Like they have their little thing and they write for their sources. And that's well and good. Those sources need good journalism as well. But the best journalism is quite often when you take something really recondite, something happened in the guts and the innards of markets, and explain why that matters to a more general audience. I think that's maybe why financial journalism, in some parts, I think the FT did a really good, excellent job. But before the financial crisis, didn't really kind of spend time getting stuck into the innards and explaining how this all worked. So I see sometimes like parallels between trying to sort of untangle the tribal allegiances and politics of post-Civil War Benghazi and Eastern Libya with modern capital markets. But, they can get a little bit fanciful. They were very different fields.
So let's now turn to your new book, Trillions, Robin. In the acknowledgements, you thank your sources for the time they spent going over the many details that make up a book about indices and make it so compelling. What was the impetus for writing the story, talk about simplicity, as simple as a call from your agent Leah after your 2018 passive attack piece?
When I first arrived in the US as the US markets editor for the FT in 2015, I started to think about what stories, what angles, what themes do I really want to own? Because at the FT, we can't cover absolutely everything. So we have to cover the stuff that's important. I don't ignore Federal Reserve meetings. So even though everybody covers that, you still need to do a good job there. But you look for the things that might get ignored, either because they're too complicated or seemingly too relevant or boring. And for me, the rise of index funds or passive investing was such an obviously great story that was being undercovered outside certain specialists because you didn't have these imperial hedge fund titans. You didn't have people really. That was the impression that a lot of people had, that, they're just algorithms and they're growing quickly, but how many times can you say it's growing really quickly? But I felt that, first of all, the people involved in the industry were hugely interesting. And this trend was so mammoth that it needed, at first, a magazine feature explaining how the industry was born and why it grew so quickly. And then my agent got in touch and said, you should really turn this magazine piece into a book. And she kindly shopped around a manuscript and Penguin kindly nibbled. But it was just the size of the thing. I still think to this day, people don't really appreciate, like even the critics of passive investing don't really always appreciate how big it is.
I mean, talking about the size of the thing, Robin, your book is replete with these illuminating anecdotes and cameo appearances from both industry and non-financial titans alike. For example, I think we get a brief allusion to Larry Bird when learning about Dimensional Fund Advisory's Dave Butler. He was almost drafted to the Celtics, or about the Barbs traded at Jack Bogle's Christmas dinner party. How did you go about mining all of your sources for this book?
One of my favorite quotes is from Isaac Newton, not to compare myself to him, but even he said when somebody was lauding his discovery of gravity, that he said that if I've seen further, it's only because I stood on the shoulders of giants. And for me, that was a lot of people like financial historians like Peter Bernstein, who'd done, God's work in a lot of the early years. So I had the skeleton of what was going on. And I knew it was an important story. And I knew it was a pretty decent story. But then you talk to everybody involved to try and really bring it to life, almost give it the cinematic treatment, to see that color that can really kind of make sure that, you actually are willing to spend an entire book on something. Everybody is pressed for time these days. And I feel like if you're actually asking somebody to buy an entire book about a subject, you try to make it compelling. And if you can find these little sort of tidbits that bring it to life and make sure that people realize, yes, this is an important financial development, but it's also fundamentally about like a disruptive technology and the people that invented it and fought against it and how they kind of finally triumphed in the end. It's kind of a familiar tale, really, that you see in a lot of other business books. And my unlikely protagonist just happened to be the index fund.
The book does a really great job of showcasing how financial breakthroughs build on one another to eventually culminate in what is today this more than $30 trillion industry that I mentioned at the outset. I guess the first really pivotal person in the story is, as you call him, the intellectual godfather of index funds, Louis Bachelier, whose research helped show that markets followed this stochastic or random movement, who may have been relegated to the dustbin of history had it not been for the faculty at U Chicago. Why was this 19th century Frenchman the starting point of the index fund?
Well, I think it's because how his ideas, after he passed away, managed to spread among some very influential economists in the US. So, I mean, he's one of my favorite characters from my book, even though I never obviously got to interview him. He passed away a long time before I was born. But I have a soft spot for people that die in obscurity, and their genius is only recognized after they pass away. And he came from a fairly wealthy family, but then suffered a series of tragic misfortunes. So he was born into a sort of a banking and wine merchant family in France. And he was going to study mathematics at the Sorbonne because he was a brilliant mathematician. But then his parents died very quickly, and he had to abort that to go back to take care of the family business at the age of 18 and take care of his sisters. And then when finally the family business was kind of, steadied, he went to go study, but then he got called up to the French army for conscription because of wars with Germany and tensions with Germany or Prussia at the time. So he only made it to the Sorbonne pretty late in life. And unlike many of the other people that studied there, he did not come from great wealth. So he had to get a part-time job working as a clerk on the Paris Stock Exchange. And that sparked interest in finance. But he was primarily a mathematician, and he showed how this stochastic movement happened. He calculated it out and also made certain observations that, today seem obvious, but at the time were kind of revolutionary. That obviously for every buyer of a stock, somebody's selling it. Presumably they both think they're getting a good deal, right? So at any given time, that price is probably the right one. Otherwise, other people will be bidding it up or bidding it down. As an aside, he never talks about efficient markets, but just mathematical equilibrium. But a lot of the work he did was reasonably well known in French mathematical circles, but he didn't get the top grade. He didn't get the très bien grade that you needed to get tenure in France. So he bounced between jobs and died in obscurity. And it was only, frankly, this guy, Jimmy Savage, who was this brilliant statistician, I think he worked on the Manhattan Project, actually, in the 50s, discovered his PhD thesis by chance and sent a postcard to one of his best buddies, who was Paul Samuelson, who was the rock star economist of the American establishment even then. And, later on, people still read his textbooks.
So no très bien for Louis, but the modern intellectual impetus really sprang from the efficient market hypothesis, the brainchild of Gene Fama from near my hometown in Malden, Massachusetts, who was trying to figure out how to forecast where the stock market would land. What's the theory, and why does it remain actually still controversial today?
Well, so Bachelier, you can draw a line from that to what was then known as random walk. So this was the random walk theory that then Burton Malkiel made famous in the Random Walk on Wall Street, and essentially was the observation that stocks seem to move at random. Gene Fama took that, 20 steps further and built an entire fully fledged, not just a model for markets, but really almost, frankly, a model for how to think about the world in the idea of efficient markets. That I think sometimes people misunderstand, sometimes intentionally because of the name or the word efficient, that they think efficient means perfect. And that's not what Gene Farmer's ever said, but it's a kind of a description of how they work, and that all the time there are a lot of participants that are, constantly baking in new information and bad information into the price of financial security. And, markets can do dumb things, but it's very hard to know before the fact when they're being dumb or when they're being smart. And Gene Farmer was the guy that really sort of helped supercharge that. And he was told about Louis Bachelier because of another mathematician, a French-Polish mathematician called Benoit Mandelbrot, who briefly taught at the University of Chicago and was a bit of a mentor for Gene Farmer, a young Gene Farmer in the 60s. That intellectual lineage helped inspire the first practitioners that really set up the first generation of index funds in the 70s.
And as we get into the 70s, and one of the central characters in the story, Robin, is Jack Bogle, the founder of Vanguard, who you devote, I think, about 3 chapters to, and also makes several other appearances throughout the book. But Bogle wasn't always a proselytizer for index funds, but as Jack Rampey observed, there's nobody more religious than a convert. Can you chart Bogle's journey from criticism to near messianic devotion?
Jack Bogle was a man with just ridiculous drive. And it came, I think, from personal challenges in his family. So he was born into a wealthy family that then almost immediately lost all that wealth in the Great Depression. Basically, the father became an alcoholic and left the family, was pushed out of the family. And the mother, they kind of managed to stay sort of middle class-ish, but they had to share a small house, and they could only afford to send one of the 3 Bogle boys to university. And Jack Bogle was the smartest one, so he got to go, he has the best grades, so he got to go to Princeton. But imagine what that does to you, right? That you're the one brother chosen. I mean, the amount of pressure that puts on you is incredible. But he worked incredibly hard through Princeton, got good grades, and then wrote his sort of thesis on this hot new trend that was kind of had erupted in the 50s called the mutual fund. This was, a fast growing, but still pretty small industry at the time. And he wrote his thesis on that. And that thesis caught the eye of a guy called Walter Morgan, who was the founder of Wellington, one of the biggest mutual fund groups in America at the time, and still is. And that's why Jack Bogle, he became a wonder boy of the traditional active asset management industry. And in the 1960, when he was still sort of a senior vice president there were some academics out on the West Coast that almost casually proposed a market portfolio fund. Not because the markets were efficient or anything, but purely because there was so much choice out there, it might just be easier to have a market portfolio for investors. And Jack Bogle, writing under pseudonym, just completely crapped on the idea in the Financial Analyst Journal and basically said this is the most ridiculous thing in the world because everybody knows that big active managers over time beat the market, which is pretty incredible given that what Jack Bogle later became, right?
I mean, you write that Bogle and Vanguard would go on to help millions of people secure their comfortable retirements and become one of the most disruptive forces in the annals of the investment industry. Why was the democratization and proliferation of the index fund so critical to Vanguard's success?
Well, the first iterations of index funds weren't actually mostly funds. They were sort of separately managed accounts and portfolios on behalf of big institutions. So pension plans that, especially primarily the baby bells. So these are the AT&T pension plan system. And they were the biggest owners of stock in America. And they could see, they had some internal data. They realized that they invested in hundreds of different mutual fund managers and they did a poor job. So indexing was primarily an institutional revolution in the first almost decade. Vanguard started the first index mutual fund, and it was a complete bomb. It was just outrageous disappointment. Because frankly, it was a very hard sell to ordinary financial advisors and individual investors. When you invest money, it's hard not to dream the dream, right? You want to be sold the idea that these mutual funds can do incredibly well. As Ned Johnson once said to the Boston Globe when he was asked about Vanguard and this idea of index funds, he said, the name of the game is to be the best. And I think especially in the US, right? The idea of just buying the market average just seems lazy. It seems like giving up. The name of the game in the US is to be the best. And if you don't want to be the best, then just give up. It struggled just culturally as well with the ordinary investors. And that's why the index fund that Vanguard launched was kind of an abysmal failure for quite a while. And it wasn't really until the late 80s and especially 90s that things really started to take off. And Bogle kind of became the person we now know as the huge zealot, the Ayatollah of passive investing.
After the break, Robin Wigglesworth, global financial correspondent for the Financial Times and author of Trillions, and I will talk about this active versus passive debate, the investment landscape, and where the future is headed. And that's all going to come up right after this.
The liberalization of LNG is creating a global natural gas market, with freight acting as a virtual pipeline between continents. ICE is home to global natural gas markets benchmarks in Henry Hub, NBP, TTF, and JKM. The nascent liquidity of spot LNG freight markets and the volatility of time charter rates has boosted demand for risk management tools. Now, you can manage LNG freight risk with ICE LNG Freight Futures contracts, which join our global natural gas complex. ICE is the first exchange to list LNG freight futures contracts underpinned by the price assessments of Spark Commodities. Spark 30S covers a route between the U.S. Gulf Coast and Northwest Europe, while Spark 25S covers a route between Australia and China. The introduction of risk management tools for LNG freight will boost the efficiency of the virtual pipeline of LNG, a new catalyst for the liberalization of LNG and a critical milestone in the globalization of natural gas. Make the connection to a global natural gas market at ICE. Get started with ICE LNG Freight Futures today.
Welcome back. Before the break, Robin Wigglesworth, the global financial correspondent for the Financial Times and author of Trillions, and I were talking about the macro factors moving markets now and during his career. Robin, the debate surrounding active and passive management remains heated. You spoke about this during your talk at Fordham's Centennial Speakers Series. What's the state of the industry and how should investors think about that discussion?
Well, I do think the debate has evolved. I mean, for the first 50 years, it didn't really change that much. It was a very sort of active managers hated passive or laughed at it. And then they used to argue that obviously this is stupid. But now the data is so irrefutable that the argument, even from dyed-in-the-wool active people, is that passive has a role in a portfolio. But active has as well. It's active and passive. And frankly, I do think that is true. And even though I've written a book about index funds, and I think it's one of the most hugely beneficial inventions that's come out of the finance industry over the past century, I don't think markets are efficient. I think there are active managers that can and do over time beat the markets, and it's not just luck. But I do think it's a lot harder than most people realize, and maybe some active managers realize. And I think that people are really good at it tends to charge a lot for their skill, or they have very hard capacity constraints. And you can literally go through the top performing hedge fund managers through history, and I think basically none of them are open to new investments and continually return the money they make at the end of every year, most of it every year, which I think is pretty telling. The smartest people, the people that are best at doing this, are saying there is limited alpha out there. I think we're still going to see a lot of money flow into passive. The arguments will go, it'll be nuance, it'll continue, but broadly speaking, the trend arrows are pointing in one very clear direction. And I think that's not going to change. And it's just going to broaden out into other asset classes. Like fixed income, we're seeing a lot of movement now.
So indices, the first of which were haphazardly and infrequently compiled by financial newspapers, did not become a ubiquitous tool on Wall Street really until the roaring 20s. What value did the investment industry see in these benchmarks when they started appearing?
Well, zero, essentially. They were a curiosity. I mean, a way to kind of see what the market overall was doing, but nobody benchmarked against it. I mean, I found one old mutual fund prospectus from the 40s, I think. There was no talk of what the wider market did. And, people primarily use these indices as kind of a way of measuring economic growth, because this was the pre-GDP days. Even GDP hadn't been invented yet. People were counting railway cars and stuff like that. And the stock market was a pretty good way of capturing economic activity. So the Dow Jones Industrial Average is one of the oldest still current indices in the world. But even there in the construction, you can see today why, frankly, that's a stupid index. It's weighted by price. So if a certain stock has a higher price, even though the company is way smaller than a company with another stock, it has a high weighting in that index. And also, it also reflects that, indices had to be compiled manually. I mean, the work involved in compiling with a slide ruler, maybe an index with more than say 30 members was just humongous. So indices were generally pretty small, and very few of them luckily were price weighted. They're mostly market cap weighted. That did start taking off in the 20s and 30s, but they weren't used. And investors didn't think about benchmarking against them at all, because frankly, people didn't even know what the long-term return of the US stock market was. Sounds ridiculous to us today, but right up until the 60s, nobody knew.
And then as we get into the 70s, I think it was Wells Fargo and John McCone started one of the first index funds, but that was only available to institutional investors. Like I think you mentioned the Samsonite pension fund that provided the seed capital for that first fund that tracked an equal weighted index of NYSE stocks. Why were the efforts to bring these to retail customers so critical to the index fund's growth and success?
Well, this was still an era when Glass-Steagall, the post-depression era regulation on banks, was pretty strict. So Wells Fargo did try to launch a kind of a crossover fund that could be marketed both to retail investors and institutions called Stagecoach. But for all sorts of reasons, it died a grisly death and never launched. There were other people that tried to launch it, but fundamentally, this was considered in the early years as something that just couldn't be sold to ordinary investors. For the reasons that Jack Bogle discovered later, and he launched Vanguard in 76, that ordinary investors like being sold a story. And until Bogle, there wasn't really a story to sell around indexing. And frankly, if you look at the first three pioneers of index funds, and they're all institutionally aimed, they came to it through very different perspectives. So Dean LeBaron in Battery March, he was an active manager. He didn't think markets were efficient, but he fundamentally felt that what a lot of clients came in through the door and asked for was a low turnover, broad portfolio of diversified US blue chip stocks. And he felt that, well, that's basically the S&P 500. So why don't we just set up a program that buys them automatically and just sell that for a low price? And Rex Sinkfield at American National Bank of Chicago, he was an efficient markets believer. He was a protege of Gene Farm at Chicago. Even he calls himself the Ayatollah of efficient markets. He believed that, markets cannot be beat, which is why he, when he was at the trust department, American National Bank of Chicago, set up or basically converted an existing fund into an index fund and used the S&P 500 as a convenient shorthand. At Wells Fargo, which got there first with this Samsonite account, it was, frankly, they just wanted to research a better way of managing money. And their research showed that this was just a better way of managing money. So some of them were believers in efficient markets, some of them were not. Fundamentally, they just believed in the data and went where it took them, essentially.
One unnamed character that is ever present in your book, Trillions, Robin, is technology. I mean, you wrote at one point about how the IBM they were using at the time had about 250 times less processing power than the current iPhone, but the technology really proved critical to developing indexing strategies and managing the portfolios. What role did technology ultimately play in this revolution to get beyond the slide rule?
If the index fund is the lone ranger of my story, the computer and the computer era is the Tonto. It really is what makes this, I think, not just like an interesting financial story, but a fascinating technology stories. This was the first fintech disruption, essentially, in the investment industry. And a lot of the stuff that people realized, there were a lot of people that had commented that, for example, stocks seem to move pretty randomly, or that active managers or investment trusts and mutual funds do a terrible job. People have commented on this, but nobody was able to really corral the data and then crunch it properly before the advent of big, hulking, but affordable mainframe computers in the 60s. So yeah, I see the computer as the unsung star here. And the index fund kind of maybe a good example of how software eating the world. is being played out, but played out in finance quicker than many other industries, because essentially the index fund is just some software. And it was fancy software in the 70s, but today it's pretty much plain vanilla.
The American Stock Exchange, which was acquired by the New York Stock Exchange in 2008, became the home of the first S&P 500 index ETF, the SPDR, SPDR. And you described the mechanisms behind it as similar to a warehouse receipt system, and that you can finance on that receipt. Why was this new wrapper so important and attractive to investors and fund managers alike?
Well, it wasn't initially that attractive, but it became hugely so. I mean, fundamentally, it had a lot of legal hair on it, because the way that, for example, the SEC interpreted certain rules meant that it counted as a continual IPO, essentially. So if you had somebody underwriting it, they have a fiduciary duty, and it was messy. And I am very thankful that I did not work on the SPDR team at the Amex State Street that did this. But essentially, it's just the ease of use. And I think that's why maybe the world wasn't quite ready for the ease of use, but this was the sort of the beginning of the internet era as well, and online brokerages were coming. So the idea of index funds, had been around for them for a long time. And Nate Most, who was the head of products development at the Amex at the time, he wanted to basically do something that saved the Amex to avoid getting eaten by NYSE or NASDAQ for that matter. And tradable index funds was his idea. He thought this was a great idea. Bogle basically sent him packing. So he went to State Street instead, that had a big passive business. They saw, that tradable warehouse receipt concept was what he came up with. That's how you can basically, you just trade the shares of this warehouse, which is the ETF that holds lots of stock. And then you allow market makers, the specialists on the floor of the Amex, to continue arbitrage and create and redeem shares to make sure that the share price of the warehouse matches the stock inside the warehouse. And as money flows in, the warehouse buys more stock or sells more stock. And it's kind of ingenious, but, complicated. But today, the ETF, I think, is really a next-gen investment vehicle as a whole. It's not just passive. That's where most of the assets are. But I think one of the things that I've been slow to realize, to my chagrin, is that the ETF is far bigger than just an index tracker.
You're right, Robin, that Blackrock has, in effect, done for investing what Henry Ford did for the car, constructing a financial assembly line that produces products for investors more efficiently than anyone else. In BlackRock's acquisition of iShares, highlighting the old Wells Fargo index unit coming full circle, it was really essential to its ability to build that scale and efficiency. Can you tell our listeners about the story of the BGI deal and how it reshaped BlackRock's legacy?
Well, yeah, this is one of the big red lines that goes through the book, because BGI was the passive giant up until 2008, the financial crisis, but only because it acquired the Wells Fargo unit that had pioneered the first index fund many years earlier. But basically, by 2008, it was this huge investment arm of Barclays, the UK bank. And Barclays, the UK bank, was desperate to avoid a bailout that might mean that they couldn't pay bonuses if they had to take stake money. So they decided to sell the family silver instead, which was BGI. Huge, massive, giant mistake. Unambiguously, one of the dumbest sales, I think, in the history of the financial industry. And the flip side, of course, one of the most brilliant deals in the history of the asset management industry for BlackRock. And so I talked about this factory. And the factory was really BGI. But BGI had always had a West Coast kind of culture about it. It was staffed with lots of former academics. It was very cerebral. They loved Socratic debate, and they weren't very commercial necessarily. So as part of Barclays, they'd been forced to become a little bit more commercial. But I think the full potential hadn't quite been realized, both on the classic index funds, but also the exchange-traded funds unit, iShares, that they had developed to sort of take on State Street. Larry Fink at BlackRock realized the potential far better than, frankly, anybody else, including certainly at Barclays. And, BlackRock, it's never been known as a place of like immense alpha or anything like that, but they have commercial nous coming out of Yahoo. I mean, they are very smart, clever people, and they grafted their commercial sense and the strategic vision best in class strategic vision with the investment factory of BGI. And together that has led to the Blackrock we know today that manages, over $10 trillion. It's just an astonishing amount of money. 2/3 of that is in passive index trackers.
In your introduction and your conclusion of Trillions, Robin, you acknowledge some of the incredible benefits of the index fund, but also dig into some comments from its critics. And you wrote that the growth of passive investing will prove one of the most consequential challenges that we face in the coming decades, not just to markets and investing, but really to the fundamental way that capitalism works. Where should we net out on index funds, and where might the index fund be in 10 years or so?
Until the day I die, I'll probably have discussions and arguments with people about to what extent index funds wreck the markets or make them less efficient or volatile or whatever. For all sorts of reasons I lay out in my book, I find many of them implausible on a macro level. On a micro level, index funds are clearly so huge that they are leaving a footprint on markets. I don't think even fans of indexing are doing themselves a disservice by pretending that it isn't having an impact. I just think that that impact is akin to any other investment vehicle. And a lot of the stuff that we blame index funds is just, frankly, it's just a convenient bogeyman for a lot of people. But I think the economics of indexing, that the big naturally become bigger, leads us to some worrying conclusions. So already there's basically an oligopoly in passive investing with, State Street, Blackrock, and Vanguard utterly dominant. And in reality, we talk about a big three. I talk about a big three, but it's really a big two. BlackRock and Vanguard between them manage $18 trillion, and they're growing far quicker than anybody else. The market's ebb and flow will change things, but broadly speaking, we're talking about billions of dollars a day. So, already they are the biggest shareholders of pretty much every major US company. And in the next 10, 20, 30 years, at some point, unless something, meteor hits us, they're going to control the voting share of every major company in the US, pretty much, almost all of them, and around the world. And, I think so far, actually, they've handled this mounting responsibility and the power that accrues to them with quite a lot of responsibility, given, frankly, pushes and pulls. Some people want them to do less, some people want them to do more, and nobody can decide what's the right or wrong decision. But fundamentally, the way this system has worked in modern sort of stock markets, it's not that 2 or 3 asset management groups, maybe 5, basically control 50% of every major stock. It's not really set up for that. Now, I think they could lead to good things. Like maybe this will be a golden era of corporate governance. In the era of dispersed shareholders, maybe nobody had an incentive to manage these companies well. And actually, maybe, BlackRock is our new corporate overlord, as I call it, and it'll be a benevolent one. But I can't help but feel uneasy about where we're heading. I mean, already today, I think there are concerns about how much power they have. But, just wait and see where we're going to be in 20 years' time. And it's just going to be, it's going to be extreme. So I think it's important to think about these issues today rather than when we suddenly wake up and realize that BlackRock and Vanguard essentially, are the market.
As we wrap up, Robin, when the Wall Street Journal published its review of Trillions, which I think was written by Burton Malkiel, the American economist best known for that book, Random Walk Down Wall Street, describing your debut book as a magisterial, delightfully written history that brings to life the eggheads and the iconoclastic investors who guided indexing through its difficult birth, bangs, and oversaw its exponential development. Any thought on maybe what your next book might be on if you've now done this magisterial, delightful written history?
Getting that praise from Burton Malkiel was so awesome that I'm worried I might never actually dare write another book again. I mean, Burton Malkiel literally lived the entire story that I wrote about. So I was, I'd heard through the grapevine that he was reviewing it. So that was pretty nervous. But I have to admit, like Paul Singer, Paul Singer of Elliott Management hates index funds, but he also thought it was, a worthwhile read. So I was pretty thrilled about that. I don't know. I mean, there's so many interesting things. I mean, frankly, there are more subjects that I can tackle than I have time for. I am fascinated by capital markets and how the bond market has taken over more and more of the world. So maybe this is too close a parallel to the index fund, but really since the invention of capitalism and basically economics, banks have been the central locus Like basically banks have been the central conduit of credit around the world since Renaissance Italy, where bond markets also were invented. But over the past century, but especially the past 30, 40 years, bonds have invaded a lot of areas that used to be the preserve of banks. And this is particularly true in the US, where I think something like 80% of all lending is done by capital markets and the bond markets, not banks. So we still have a very bank-centric view of how the financial system operates that I just think is not accurate anymore. And it's to our detriment to understand both the sources and solutions to potential crises. So I love both that sort of big subjects like that, but also I love the history. And the bond market's had a lot of amazing characters over the years. So, I don't think it'll be a book, but that's a project I'd love to get stuck into at some point. So if anybody's listening knows some really good characters from the bond market's early days in the US, I don't know, the birth of the MBS market, that would be great.
I think there may be some here at Intercontinental Exchange, and we've got a lot of listeners there. And if any of that bears fruit, please give us an acknowledgement in the next book's jacket. Robin, we're recording this right before Liverpool, your soccer club, is set to take on Inter Milan for the Champions League title. Do you expect a 7th title for your club? And then could we expect an ETF based on soccer championships anytime soon?
I mean, on ETFs, I kind of figure like if you can envisage it, somebody's going to make it at some point with ETFs. I mean, some of the innovation there is, if you're being charitable, pretty exciting. If you're me, then you think it's gone over, gone a little bit overboard. Whether we're going to win the Champions League, it's tough. I mean, I think we've got a good shot and we've got a great side, but I went through 30 years of very lean, terrible Liverpool teams. So right now, I'm just really enjoying chairing a likable, exciting team with a great manager that is competing for top titles. So whether we win them or not almost feels that's like the cherry. I'm still enjoying the cake of actually looking forward to a match and not watching it through my fingers, as it were.
Well, I'm looking forward to having you actually inside the Ice House, the New York Stock Exchange, on your next visit to New York, rather than looking at you on a video screen from Norway. It's great to talk to you now, but look forward to having you back again soon.
No, thanks, Josh. It's been a lot of fun. Thanks for having me on.
Well, that is our conversation for this week. Our guest was Robin Wigglesworth, global finance correspondent for the Financial Times and author of Trillions: How a Band of Wall Street Renegades Invented the Index Fund and Changed Finance Forever. If you like what you heard, please rate us on iTunes so other folks know where to find us. And if you've got a comment or a question you'd like one of our experts to tackle on a future show, email us at icehouse@ice.com or tweet at us at Icehouse Podcast. Our show is produced by Stefan Capriel with production assistance from Pete Ash, Ken Abel, and Ian Wolfe. I'm Josh King, your host, signing off from the library of the New York Stock Exchange. Thanks for listening. We'll talk to you next week.
Information contained in this podcast was obtained in part from publicly available sources and not independently verified. Neither ICE nor its affiliates make any representations or warranties, express or implied, as to the accuracy or completeness of the information and do not sponsor, approve, or endorse any of the content herein, all of which is presented solely for informational and educational purposes. Nothing herein constitutes an offer to sell, a solicitation of an offer to buy any security, or a recommendation of any security or trading practice. Some portions of the preceding conversation may have been edited for the purpose of length or clarity.